Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property, finance and money management. Hello, Ben.
G'day, mate. How are we?
I'm very good. How about you?
Good, terrific. Well, you know, both of our footy teams had good wins.
They did.
On the weekend, so we're playing finals. How about you guys?
So you had a good week this week. You had notice I'm moving straight on. You had a finance development day.
Professional development day. Got to keep up my CPD points, mate. We've got to, you know, when you're qualified to do things, you've got to make sure you retain that qualification.
Well, what I thought is we'd actually tap into your match fitness around this very topic today.
Yeah. So
because there's a rumour that you're a mortgage broker, because the Shadow Treasurer, Chris Bowen, named you as that mortgage broker in the Financial Review. Yep. And of course you were a mortgage broker in your previous part of all the early days in the business. So we're going to tap into that today, folks. So we're going to talk about structuring your loan. Ben's going to actually take us a little bit of a walk down memory lane, which will be really exciting.
Borrowing power, Bryce. That's the theme for today.
Borrowing power, I like it.
Borrowing power.
Hey, before we get there, let's just do a little bit of a tidy up. We're getting to the pointy end, Ben. So there's some really great prizes on offer in our footy tipping. So Burrow with a double R.
Burrow.
Got 9. Aced
nice
it.
Work.
Good ace there, Burrow. Well done. Margin of 13, which is nice. But I just wanted to give a little bit of an update on where the leaderboard is, Ben. Father of Dragons is leading. 117. Spiro Malakalis.
Spiro.
Second at 116. And just Nick. No surname, no nickname.
Right,
Nick. Is on 116, Stiggy. Okay,
right.
doing a little bit better than you over there too.
Game on. How many more rounds to go? 3?
I don't know.
Or 4?
Must be 3 or 4.
Something like that.
Last day in September. What are we? August. There must be still 6.
Jeez, we're all over it.
6 to go. I would have thought.
No, it's definitely not 6. It's only like
because finals, 4 weeks of finals.
Correct,
yeah,
3. You know, it's at the end of August, so we'll be announcing
clearly I haven't looked at the round for a little while, so
we'll announce it. We'll announce it at the end of August.
So good prizes: property portfolio plan, property plan, and also a catch up with us, so we can do a little mentor session. So
yes,
get your tips in, folks. So just a reminder that if you are new to our podcast, at the end of the podcast, Ben, there's an opportunity that we give you to download our binge guide. So stick around all the way to the end, and you'll be able to catch that. Okay, my Mindset Minute theme today is it's from William A. Ward, Ben.
Okay.
The pessimist complains about the wind. The optimist expects it to change. And the realist adjusts the sail. So, what does that actually mean, Ben? It's really, I guess a setup for the fact that there's people that tell us why property won't work, and there's people that say, well, when this scenario happens, property will work in the greatest way. But what's really important is the people who are actually getting the knowledge, Ben, and acting on it. So the pessimist complains about the wind, the optimist expects it to change, and the realist adjusts the sail, from William A. Ward.
Love the realist.
Hey Ben, Q&A day. So I've got a number of questions here lined up from our listeners. We sent out a little email this morning, and we got a response from that. So folks, if you want to be on part of our community, you want to get all the latest updates, we do a monthly update, but you also want an opportunity to contribute on the spot whenever we're doing a Q&A. We will put the shout out on the day that we're doing Q&A just to get a last little relevant question. So if you want to be a part of that, go to thepropertycouch.com.au, leave us your details there on the homepage, download that free chapter, and we will give you that opportunity. But Ben, borrowing power.
Well, I just thought, now that the dust has settled, Bryce, so if you think about it, so we had rates on hold. That's after 2 months of changes, so June and July, dropped the cash rate by 50 basis points. And we had APRA come out with their revision, I'm going to get technical here, Bryce, of the Prudential Practice Guide APG 223 on residential mortgage lending. So they've made their changes to that, and I'm going to talk through some of those changes. But what I thought I'd start, now that the dust has settled, is a 2-minute history of lending in this country. Are you ready?
Well,
put the timer on.
Let's put the stopwatch on.
All right, here we go. Brief history. pretty much before, in the 1980s, before that no one ever borrowed money, that's not true, but you used to have a 20% deposit. And then through the 80s, we started to change that. Lender's mortgage insurance started to be a thing. We introduced products like offset accounts and all that, which is Australian made. But in terms of that, back in the 80s, very few borrowers, very few options in terms of lenders to be able to borrow money. Not very few borrowers, but very few lenders. 1990s, right? Brokers get their foot into the market for the very, very first time.
We'll save you.
So, yep, we'll save you, Aussie John, and then Mortgage Choice, and also AFG. So it started in the West, right? Started in Perth. And then they brought it across to the east. So that meant...
Do you remember Wizard, Mark Bruce's?
Yeah, Wizard Home Loans, all of those guys got into the act. And that meant exactly what you were just talking about, Bryce, distribution for non-bank lenders, right? So really the 1990s was the footprint of starting to get some choice, right? Then in the 2000s, we started to see more product options. Okay, so we had authorised deposit institutions, so all the banks, and we also had these non-bank lenders and tier lenders and blah, blah, blah. So that did definitely mean that there were some more aggressive products that came into the market, Bryce, and a lot more competition, right? So what were some of those aggressive products that we saw in the early 2000s?
Low docs, no docs.
Very good. No deposit home loans. So basically you didn't need it. Those were the days, right? And servicing and assessment standards did change in certain countries and were relaxed a little bit.
Ninjas.
Ninja
loans, no income, no job, no assets.
That's it. And that pretty much led to a small thing called the GFC, the global financial crisis, because we had Greenspan in the US basically saying low interest rates, which meant that what was happening, right, was they were bringing rates down to virtually zero, and then assessment rates were so low, like 2% assessment rates, 1.5. So people on 30 grand could like borrow $300,000. It was ridiculous, right? Hence we had the property crash in the US, and that led to the global financial crisis.
Which coined the term jingle mail, Ben.
That's right.
Because they don't have non-recourse.
Correct. Non-recourse borrowing is over there. So
it meant if you can't pay the loan, you put the keys in the mail, send it back to the bank and say, thanks for the opportunity, I'm going this way, you can deal with it.
Now, fortunately, our regulators weren't asleep at the wheel like they were in the States. And we did have assessment rates at a reasonable level, and also we had full course borrowings. So in terms of that meant that your obligation was you can pay it, and you couldn't just send your keys back in the post or the jingle mail. We come to the 2010s, and this has really been post GFC, the decade of reform and the decade of heightened regulation. And we've seen that really come to a fore at the end of, as we're coming to the end of this decade. We are absolutely seeing that post the Hayne Royal Commission in terms of what's happening here. In fact, CBA released their numbers yesterday, and just to give you an idea, their ongoing costs to comply with new regulations is almost $300 million a year now. In terms of putting that. Now, in terms of rectification of products and services which weren't appropriate, over $2 billion, Bryce. So that just tells you that we are definitely in this, as we finish the end of this decade, where also two other big things are happening, right? So we also saw the beginning of low interest rates globally, not just in certain markets, but we're now starting to see that play out here in Australia, and they will be lower for longer. In fact, Bryce, the 10-year bond rate got below 1%. It's the first time in history.
So for the listeners at home, let's explain why that's important.
It just basically means, I summarise the bond market as this, right? That's where you play safely, and you play in the equity markets for greed, right? So safety versus greed. And what the bond market does is that sets the price of money, right? And if there's a flight to safety, normally money goes into the bond market, or it goes into the share market if people think it's really comfortable. So when there is a flight to safety, usually that means the bond yields go down a little bit. So we've got this 10-year bond yield, and 30-year bond yields are under 2%. So that says to us that if you think about long-term mortgages and long-term cost of money, it's going to be lower for longer. Right? Now, that's a live market, that changes every day, but as it currently sits today, those markets and what happened this week and last week. There's been some milestones in there. We've seen some corrections on the stock market. We won't go there because I'm getting over my 2 minutes. But now, Bryce,
I chuckled at the 2 minutes anyway. So
well, that's low inflation and low wage growth. And that's going to be a thing of the gig economy, right? As everything is democratised and efficiencies and productivities improve through the use of machines and computers, that will be pressure
in some... the gig economy?
It's the gig economy, which effectively...
The gigabyte economy?
Well, it just effectively means that people will trade their time for... So there'll be a lot more contractors and people doing that type of work as opposed to the more permanent work that we've seen traditionally. And that means that people offshore in other countries will do some of the work that you need done here because it may be cost effective for that work to be done as opposed to the cost here. So that's the gig economy story. And so the final thing, Bryce, that we're seeing that's just happened in the last couple of years as we finish off this decade is pricing has changed for different products. So owner-occupied, principal and interest versus interest only, and then investment interest only versus P&I repayments. They've now got different pricing models. And that's what we're going to be talking about today in regards to that borrowing power. And Bryce, for the 2020s, I'm going to term a new phrase. Are you ready for it? Are you ready to hashtag it? Because this one's going to go global.
Yeah.
Right? And it's effectively, what's happening is it's throttling. So we're going to see, and this is the way in which the regulators are going to throttle mortgage lending. Okay, so similar to the way in which, you know, they throttle data plans. If you use most of your data, the speed in which you get that, that's exactly what they're trying to do in the mortgage market because of the fear of asset appreciation getting beyond its fair market value, right? So that we've talked about that plenty of times in other podcasts about winter is coming and things move beyond their fair because people act irrationally. So that's what they're doing. So part of me says I don't mind it in the sense of trying to keep the economy safe, and the prudential regulators, as their name suggests, prudential means that they've got to make sure that the banks are healthy and are low risk and the economy doesn't implode because of our banks' baseline level of assets and protection they've got in there. So the 2020s is going to be a period of throttling. And we're seeing the first bit of that throttling happening now at the end of, so they throttled really hard, they throttled on interest rates, they throttled on interest only, they basically set the assessment rate ridiculously high, and they stopped the property market in its tracks. And now they're trying to release the throttling a little bit by doing this, these new reviews. So what have they changed? Okay, so for our
basically, just for clarity, is this still part of the 2 minutes, or have we full?
No, we're done. That was the back history, right? Because we're here now.
Good.
Here today, right? So from July, or post July, the floor rate was 7% set by the regulator. That's APRA, and they also encouraged a buffer of 2%. Now that meant that on existing lending, you would do a loading of 2%, and any new lending they would want a floor rate of a minimum of 7%. So most banks post the Hayne Royal Commission are like, well, we're not going to 7. I mean, that's the floor rate. Like, we've got to be careful. So let's do 7.25. So that was the accepted assessment rate for lending post effectively the property boom, right? Now, where do we go? As of July this year, we changed that. So now the banks are asked to do their own floor rates. Now, a floor rate, and I think this is important, right? Because in terms of the floor rate, that's effectively saying to the bank, we want competition in the marketplace. So what is your floor rate? In other words, if we're going to assess your business in terms of the risk and the security and safety and basically the strength of your bank, then you've got to tell us what you think the floor rate is. And that will allow us to go and test your books and basically see, your prudential strength. And so that's new, right, in terms of, and I like the idea that it's up to the banks to set their floor rates, still being responsible lending guidelines and everything like that, because ultimately banks are in the business of lending money. So they now set their own floor rates. The other thing that then changed though was the buffer was increased to 2.5. So what they call it is the sensitivity margin.
Yep.
Correct. So the sensitivity margin now moves to 2.5%. So what does that mean? Well, we just had to wait and see what all the banks are doing. That's why we've been waiting until today's episode to basically tell us what they set their floor rates at. Now, I've only got the big four plus Macquarie, just to give you an idea. So Commonwealth Bank, and Westpac, 5.75 is their floor. ANZ, NAB, 5.5 is their floor. And Macquarie Bank, 5.3. So effectively you can see the big four banks that have a lot of branches and distribution, that's about right. You know, their floor rate is reflective of all of their costs and distribution to be able to look after that. Macquarie doesn't have a lot of branch network, so hence their floor rate's a little bit lower. So you can see how they could argue that with a prudential regulator, and that's the floor rate. Now, the most important thing when we're doing the calculation, right? So what APRA has said is you've got two choices, right? You can use the floor rate as your assessment rate, or a sensitised rate, meaning that a calculation that you can perform, and whichever of the two is the highest is what you have to use.
Yep.
So you can't just go straight down to the floor rate, because that would be, I mean, you know, Macquarie Bank at 5.3, it'd be woohoo! From a 7.25, that would open up lots more borrowing power. And this is, remember, we're trying to explain this all about borrowing power. And it's
because that's important, isn't it? Because it's about your ability to get the next loan, not what you're paying on your existing loans. Because it's largely that, like you say, if it goes from 7.25 to 5.3, that has a dramatic impact on post that decision and pre that decision, how much you could borrow without any other circumstances changing.
Well, it's a good point, Bryce. I mean, in terms of when we were doing our property plans, so, you know, we talk about, we measure cash flow movements every month for the next 40 to 50 years. It's fundamental in terms of making sure that, one, we're maximising the cost of money, and we're also making every dollar work as hard as it possibly can, but we're not overcooking it. So we've always used a 7.25% long-term interest rate as well. But even in our investment committees, we're now talking about moving that down because we're robbing people of potential opportunities. So when you're talking about investment-savvy mortgage brokers, you also want to make sure that they're not getting you into too much mess. Now, when customers would come into us, we would never ever, in terms of the models and our purchase price recommendations that we made, you could always borrow more back in the old days, right? That was but since about 2015, it's now the other way around, where you actually can borrow less than what we would think as being a sensible level based on each household, because again, we do tailored solutions, right? So with that in mind, how do you calculate the higher of the two in terms of the sensitised rate versus the floor rate? Well, this is how you do it.
All right, so let's take it slowly, given we're on a podcast here. No visuals. Standard
variable minus the discount that may be offered by the lender, plus the sensitivity margin. Just that simple. So by way of example, if I had a 4.93 standard variable rate, what an investment-savvy mortgage broker would always do is they'll put a pricing request in. If your broker is not putting a pricing request in for every loan that they apply for, then they're robbing you of borrowing power. Tip number one, must put in a pricing request. That pricing request will then come back with a figure. In this particular example that I'm using, it was a discount of 1.43. Okay. So I've got 493 minus 1.43. Then I add the sensitivity margin on it, and that is 2.5%. So I come up with a figure of 6%. Now, if I go back to what the banks were, you remember the floor rate for CBA and Westpac was 5.75, ANZ was 5.5, and Macquarie was 5.3.
So this is the higher of?
Correct. So you have to use that. So that becomes the assessment rate. Now, again, going back to when life was easy and the average person could understand, great, okay, so I know that lenders are assessing at an assessment rate of X, but it gets more complex now because we have different pricing for different products, i.e. owner-occupied, principal and interest, owner-occupied, interest only, investment, principal and interest. So there's 4 product ranges now. And that has resulted in 4 different assessment rates for every potential loan split that you're looking to do. So more than ever, your broker is your best friend because they are going to be doing a lot more analysis work to try and get the best return. And by that we mean making sure that it's still responsible lending, but also giving you the best outcome in terms of the borrowings that you want to get. So if, again, caveat, if you are a bad money manager, if you spend on discretionary items, then the reality is that your broker is still going to say, I'm not going to be giving you the maximum borrowing power you can go to, because I have no confidence in you being able to look after that. And we've talked about that on previous episodes where we talk about essential and discretionary spending. And we've talked about, leading into getting a loan, demonstrating your discipline around what you are spending money on will be a factor. Okay, and what's interesting about the way in which, obviously in our business, and we're producing around 40 million in loans a month, as you know, that's why we price every deal, because we want to make sure, and when we price on the alternative. So give us the best possible pricing discount you can, Bank A, based on investment interest only and investment P&I. And then we have a look at both of those and we come back, because what I'm about to share with you is some of the variances in terms of borrowing power. So I know it's a listening podcast, it's not a demonstration in terms of that, but that sets the scene for us to talk about what it looks like, okay? So I want to go into that just by sort of saying, here's an idea of a typical bank and what they might have as their assessment rate. So principal and interest, assessment rate could be as low, for owner-occupied, could be as low as 5.93. For interest only, it could be 6.42. So you can really see that broad difference, right? For investment, it could be investment, principal and interest, 6.36, and investment for interest only could be as high as 6.74. So you can see the variances there. And that's why...
Okay, so we'll just summarise that again. So you had 5.93 versus 6.42 owner-ox.
Correct.
That was the first one, 5.93 is P&I and interest only 6.42, so you can see the difference. Or swing that over to investment rather than being a principal place of residence. For P&I, you had 6.36 versus 6.74, Ben. But what I can tell you, folks, is none of them were the same.
No, that's right. So we'll put this little table, we will take the bank out, but which for illustration purposes only, we will put it there, because what you've got to do is you've got the reference rate, you've got the floor rate, you've got the sensitivity margin, you've got the discount, what is the actual rate, what is the sensitised rate, what is the assessment rate, and then bang, what are those repayments around that? So it really is going to be a good news story for you in terms of getting the comprehension right. Because Bryce, we're here to teach. We are here to teach, and as much as we like to keep it simple, there is some complexity in this, and we're trying to summarise it as best we can. So let's put that now into an example, Bryce. So what we've done is our team here have put some numbers together.
They have.
So for a single person on $75,000 of income, gross income, with monthly living expenses of $1,700 for an owner-occupied purchase for principal and interest. So if you're looking to buy your first home and you're a single person, what does this mean for you in real terms? So in the previous assessment rate was 7.25. That effectively meant that you could borrow $450,000 on that simple example.
Yep.
On a 6% assessment rate, it actually means you can borrow $515,000. So if you put those two numbers together, Bryce, you can see that it's
more money, Ben.
$65,000 in additional borrowing power. So now what we wanted to do is okay, let's have a look at our investment community in terms of what they can do. So I gave Matt a bigger challenge, one of our brokers here, and I said, Matty, let's do some analysis. Let's bring in a couple. Okay. Right? Most people these days are borrowing money as a couple. So let's go to the owner-occupied purchase, right? So what we've done here is we've said each couple is on $75,000. So we've got household income of $150,000. We've got living costs of $3,100 per month, and there's no other existing debts. Okay. Now, in terms of, for the illustration purposes, we've gone off to the bank for a pricing request, and they've given us a 1.5% discount on the money that we want to borrow, and we're using an interest rate of 3.43. So once we get that discount off the standard variable rate, it means that the interest rate is 3.43. Now remember, we add the sensitivity margin to that.
2.5.
2.5, correct. So it's 5.93. So that becomes the assessment rate, because that's higher than the floor rate that we learnt before. So That would mean that previously this couple could have borrowed $950,000,
Ooh, yes.
but as of today, Bryce, they can borrow $1,090,000,
Okay, Ben.
which is obviously
Can I
an
do a quick
increase.
maths on that? Let's say that's giving an extra $140,000.
Correct. Wait. But what if you wanted to borrow interest only first
Ooh.
for 5 years?
Okay.
The assessment rate changes because the standard variable rate is higher for interest only.
Yes.
So we've got 5 years. We still get our 1.5% discount. So the bottom line there is that the maximum borrowing power at 7.25 is 895,000.
Yes.
But under the new policy,
Yes.
the interest rate, the assessment rate is 6.43.
Oops. Yep.
Not the 5.93 because of the loading rate.
Yep.
And that meant that we can borrow $965,000.
All right, let's do the maths here. That's an extra, I know you've done the maths, I'll quickly do it, $70,000 versus 140 at P&I, Ben.
Correct. But also what is interesting about this, Bryce, because we have in the past, and this is one of the bigger changes here, and one of the things that we need to, we've always talked about very strong positions on running interest only and also running offset balances, right? The argument could be, in certain circumstances, it may be better to go principal and interest for two reasons. One is the discount is slightly better in terms of the interest rate.
But more importantly,
your borrowing power could also be improved.
Yep.
And that's where the highlight is around whether you're investing for the long term and you've got future acquisitions to make. You know, we talk about the chess game playing too.
I was about to say the same thing. Well, this is the reality of, we've used the chess analogy many, many times. Now people can start to see what happens if you move this piece.
Yeah.
What's the next move? Who's going to come and take your pawn?
And this is where your investment savvy mortgage broker will do all this analysis for you, and then present the findings that we're doing. So let's go to the investment purchase,
Okay.
right? Because this is the fun one, right? Because this is the one where we spend most of our time in.
Yes, we do.
Now, so same couple, same incomes.
Yep.
Same baseline living costs of $3,100 per month.
Yep.
No existing debt. These guys are going to be rent investors, remember? Because they're investing for the first time. They've got no existing debt. So their rent per week is $450. Okay? But the income they're going to get on that first investment property is going to be $700. So they're chasing, in our view, they're chasing a more premium, scarcer asset with owner-occupier appeal. So they're going for a bigger acquisition cost. We're not factoring in any deposits and all of those things. We're assuming all those things work. So here's where it gets interesting.
Okay.
We put the pricing request up to the bank. And what did we get? We actually got a bigger discount. So instead of the 1.5, we got 1.7. So even though there's a loading between the two, this is a trick for, you know, and this is why we need to keep it quiet, because we don't want the whole world to know. But ultimately, the banks, even though they have higher interest rates on their carded rates, in some cases, we can get some discounts that reflect the appetite for the bank. And this is what they say, that their pricing is one-to-one, and in terms of the type of customer that they're looking for. So in this particular case, we got a 1.7% discount. So with that 1.7% discount, it means that the end rate, so 5.51 was the carded rate. We got the 1.7% discount, so 3.81. Right, so 3 plus our sensitivity margin, the APRA sensitivity, that means it's 6.31, which is higher than the floor rate, which ultimately means that's what we'll be assessing at. So go back to previous history, 7.25 meant that they could borrow $1,040,000.
Yes.
Under today's conditions, with this particular lender, the assessment was $1.17 million.
It's an extra $130,000, Ben.
Correct. But Bryce, interest only, like, you know, it's deductible debt. So when we might have some other non-deductible, so that may be in our best interest that we would look at sort of going interest only. What does that mean for us? So the carded rate is actually 5.89.
Yep.
Okay. Less our 1.7% discount means that
4.19.
4.19 will be the interest rate that will appear on our bank statements. But in terms of the assessment rate, in terms of the appetite for the banks to lend to us, if we go back to the 7.25 previous earlier in this year, I would be able to borrow $990,000. But under the assessment rate of 6.99, I would be able to borrow $1,050,000. So under the new assessment, there's an additional $60,000 there.
Yep.
Now compare that to principal and interest versus interest only for the investment lender. That's a $120,000 difference. So that's quite interesting, isn't it? In regards to, would you go P&I on an investment purchase because you can borrow more, or would you want to take the discount in terms of the benefit of the interest only?
Yes.
And this is why, case by case, we are saying to you, and we're not necessarily saying you would want to max out your lending. It all comes back to what we were saying before. Put our caveats up front, and that is responsible lending, what you can afford. But it does highlight this throttling, this idea that the regulators are keen to work with the banks to throttle lending, and that will have an impact.
Hashtag throttling, Ben, I think we need to say. But now people are running, they're at the gym, they're on the train, they're driving in the car. So let's just go back to that. So for owner-occupier, principal and interest, you had, was $950. It went to $1,090, which was a $140,000 difference.
Correct.
And then for interest only, it was $895 under the old rate.
Yes.
Went to $965, which jumped up by 70. So
Correct.
that was for your own home. For investing under the old system, 1040, Ben.
Yes.
Which became 1170, which meant an extra 130,000.
Correct.
But on the interest only scenario, was 990, now 1050. So an extra $60,000. There's a lot of numbers running through, Ben, so we're just going to make sure it lands on people while they're listening to this.
Correct. So if I was to summarise that, depending on my situation in terms of if I'm still in accumulation phase or if I'm in pay down phase and this is the last purchase, I would consider a P&I position as opposed to an interest only position, which has been a long-standing position on the two fronts. One is it's a cheaper interest rate, but secondly, that borrowing power may have been able to secure that final property. But if I did go P&I, and this is where it gets quite interesting, and again, we don't want to be drinking from the fire hydrant too hard, but if you've got existing debt, that existing debt is also going to be assessed at a 2.5% additional loading, right? So, and that's with ADIs, authorised deposit taking institutions. If you're talking about the non-bank lenders, and this is why we're also saying for some people, in terms of the craft here, the strategy here, if you want to get those funds based on your risk appetite and also what's important to you in terms of what you can afford comfortably, you may structure yourself with Bank A, but you might also go to other lenders whose assessment rates are different and their borrowing power may be higher if you want to achieve a better selection of asset, if that is the case. And we're not necessarily saying that the higher value you go to is the best asset, but what we do know over the very long term is that the land in better established areas appreciates better, okay? And if you can get that great suburb with owner-occupier appeal, high status, all the things we talk about, you could potentially get that outperform result. Because investing is about the overall return. What we've focused here today on is the cost of operating that overall return. And that's also an important consideration, but I'll always say asset selection will always trump, and being able to be in control of better assets over the longer term will always trump any cost associated with that.
Here, well said. So I guess we talk about the property investing being as much a game of finance as it a game of bricks and mortar.
Yes.
I think for the last 20 plus minutes, Stiggy, I was saying 30. That just goes to show what permutations and what sort of chess pieces you need to move to actually make this work. So folks, if you're not dealing with an investment savvy mortgage broker, some of that stuff that we just talked about could be opportunity cost for you. So
And I'll highlight it, Bryce, by saying you can get onto those calculators on websites and stuff and have a look, oh, that's all I can borrow. I promise you, those calculators are miles off these days because of all of these permutations and combinations that we've just talked about. So I would also say, in some cases, a flag out to the investment savvy mortgage broker. What used to take them with one assessment rate and one actual carded rate, maybe 30 minutes to an hour to analyse,
yes,
can now actually take 2 to 3 hours of solid analysis before they can get that right combination. And then it's educating the customer in terms of what that looks like. So again, there's a learning exercise there because it's all new information and it's not the layup that it used to be. So be mindful of that for your investment savvy mortgage broker if they're taking a little bit more time in running those numbers, because the more time they're taking, hopefully the stronger the solution and the biggest problem solving work that they're doing.
Sticky, what we might do is put the link to the episodes, the original borrowing power episode, what to look for an investment savvy mortgage broker, how to survive the credit crunch. We've got a bit of a back catalogue, and so some of our listeners might have only just joined our community, been in the last little while, so we'll make it nice and easy for them to find where they are in the show notes.
And all of this supersedes that. So that's why we thought it was really important once the dust settled, because if we had another rate cut, we probably would have said, let's wait again. But we've got probably a window now where there's probably not going to be one more rate cut until October, November. So we thought the dust has settled.
Yep.
Let's have a look at those numbers today. But what effectively this is also meaning that the lower the rate goes, there will be additional borrowing power available, but it's not going to be hundreds of thousands of dollars, right? Because we don't, again, want that, that bubble, that asset bubble happening because cost of money is cheaper.
So folks, what I recommend for some of you, Ben referenced it before, if you feel like you've been drinking from a fire hydrant with some of that stuff, because we get that you're listening to a whole bunch of numbers, today's episode more than anything is probably a fair bit of back 15 seconds, and just slowly go through it and let it land. Because really what it comes down to is understanding that there was an old assessment rate and now there's now a new regime for an assessment rate. And the way that assessment rate is determined is by two metrics, and working out which of those two metrics is the higher, because that is what they'll use. That's the summary.
Yep.
But in terms of the nuts and bolts and some of those numbers that we're running through and which you and the team have prepared very, very well, I just suggest don't be shy on hitting back 15 seconds just to really let that land, because it's really, really important. Or
rely on your investment
I was
savvy
about to
mortgage.
say, or if you haven't got time, get your investment savvy mortgage broker. So we'll put the link in so you know exactly what to look for with an investment savvy mortgage broker. So, well, mate, that's nice work. We've got some questions here that are finance related.
Yep.
I got this one from Bella. Bella was on our mail out spend, so she had the opportunity to send a question in just this morning.
Sure.
We just bought a house and are setting up our loan. Should we get our wages put directly into our offset account and pull the money into our everyday account for expenses and keep a minimum amount in there, say $2,000? My husband wants to do it the opposite way and just pay our offset with leftovers after expenses. What should we do? Help! Well, Bella, what I would say is we need your husband to listen to our Money Smarts episode. And in fact, why don't you reach out to Ivis, info@thepropertycouch.com.au, because we agree with you. Your husband needs a little tweak in thinking there. So send us an email. We'll email you a copy of our Make Money Simple Again book and hopefully get your husband to have a look at that. But there's a couple of pages in that book where you can pretty much get the overview of the book graphically in the images that we've got. So if your husband or anyone else who's got a similar question, if you're not a reader, you could still get your hands on the book, because if you just study those representations, the graphical representations, you will have a 30,000 foot view of how you should structure it, whether you are on $1 million a year or whether you're struggling to scrape the pennies together. The principles are exactly the same. So,
and why are you right, Bella? Here's your 3 responses to your husband when he pushes back. First one is that you will know what your living and lifestyle, your weekly allowance will be, and that will be the money going into that discretionary account, and it will go every Thursday as our recommendation. So that will then allow you, number 2, to consciously spend. So one
Big
versus
one.
unconsciously spending. We've been on about that.
Consciously spend.
So they are the two big reasons. And then the final reason is if you have your money sitting in your non-offset account,
Yes.
you're not getting interest savings on it. I mean, that is a
Calculated daily, paid monthly. Calculated daily. Tell your husband every day it's not in there. It's another day that the calculation's being made on a higher amount.
So you're just giving the banks more profit. So I'd prefer that profit to be in your pocket, not necessarily in theirs. So as always, every dollar, including rent, dividends, any type of money you are receiving, its first home is the primary offset account. Or if you don't have an offset or you start saving for deposit, high interest savings account. That's it. Then you drip feed money into your spending account, which is your living and lifestyle 7-day float. And for the ad hoc spending, you can track those particular expense items. It is really simple. And I would also encourage you, not only for the book, but cheat by using the platform that we have free and available, which is thepropertycouch.com.au/financial peace, and set up your Money Smart system there. Because once you do it, you're all over it.
And there's a Facebook group too, Ben, Make Money Simple Again. You can come and be a part of that. There's heaps of people in that community, Bella, who are firing questions. They're getting amongst it. They're comparing their credit cards and their interest rates. A really, really good community.
It's terrific.
So you can be a part of that. Bella, that's a good one. Can you please reach out to us, info@thepropertycouch.com.au. We will send you a copy of the book to help with your husband, and let us know how you go. Okay, this one's from Todd. Love your podcast. I've learned so much since I found it 6 months ago. My question is loan structure related. With tighter lending these days, is it an optimal strategy to split my principal place of residence loan into 3 or more splits so I can pay them off quicker and then re-borrow once paid off to invest? Or is it better to build up a large sum in my offset account? Thanks in advance, guys. And go Eagles, fellow Sandgroper, but clearly the wrong allegiance. And also go Stig.
Oh, go Stig. Well, she does a great job. Without her, this show wouldn't even get to air.
Let's be honest, without Ivis, we wouldn't have made it past episode 2. So, Ben.
This is why would you complicate your financial operations into 3 different buckets?
Correct.
When the proven principles are following success of our forefathers and grandparents and how they did it. They organised their money, primary account, one offset, weekly transfer for your living and lifestyle, and that's it. You don't need to worry about different buckets. You will see that offset bucket building up beautifully, and that's all you need. Don't overcomplicate it with different types of buckets for different types of things. If you set up Money Smarts properly, it's that simple.
I was about to say, Ben, major in the basics here. Go back and understand the basics of Money Smarts. If you understand it and follow it and put the principles in place and get your banking architecture in place, that question becomes a moot point. So major in the basics
and
there, Todd.
Set and forget. It just happens.
Get on with having a good life.
Check in every 10 months with, and do your bank. Just see how you're tracking.
10 minutes a month.
10 minutes a month?
You said every 10 months.
Oh, did I? Sorry, 10 minutes a month. Too many numbers today. 10 minutes a month. And you just, for those expense items that you're curious about tracking because they're ad hoc, just load those numbers in, hit your button, and all of the data is all calculated for you. You can see your spreadsheets and your graphs. It's that simple.
If you can't afford the book, let us know. You send us an email. We'll email you a cheat sheet for those people. But if you can afford the book, go and get the book, because just major in setting it up correctly, and none of these questions will pop up for you. But good question, Todd. Thanks for sending that through. In fact, anyone who gets a question read out anyway gets a book.
And that's right,
so
free book.
Maybe we'll get that one to you as well. That's coming to you. You're laughing. Why are you laughing? James, with the RBA's drop in interest rates to 1%, I, like most people, are considering refinancing away from my current mortgage provider. We have been looking into a few options, but keep hitting a hurdle, Ben, that due to being on one wage and having 2 properties, i.e. our PPR plus 1 investment property, as I am currently on a non-permanent workers' compensation payment through DVA, the banks will not recognise my wage as a salary, Ben. So, my question is, with APRA's change and loosening the reins on lending, has this already come into effect? Well, yeah, we talked about that today. If not, when is it due to be implemented by the banks? Thank you, James. Let's talk about the first part of that question.
Well, so the first thing he's probably incorrect on is it's not loosening, right? I mean, they are not loosening credit policy. They go to the nth degree to explain to the bank that you still need to be prudent in your lending and responsible in not putting that client into financial stress. Now, James, you gave away the challenge for you, and that is, imagine if it was your money and you wanted to lend it to somebody else. You would want to make sure that the income that was going to repay the loan of your money that you're lending someone else was consistent and permanent. And you've said to us that there is inconsistencies in that payment that you're receiving. And because of those inconsistencies, and there's no guarantee that that income will flow, they're not going to lend to you based on that technicality, right? And it's an important technicality. So similar to people who are on casual wages for a short period of time. Casual wages over 12 months, 2 years or whatever, the banks have policies for that, and you've just got to find the right bank who has an appetite for people who have been long-term employed, even if they are on casual contracts. That's coming back to the gig economy piece. So if you're going to return to work after you recover from your situation, if that is the case, then the reality is the moment you return to work, your income will be part of the assessment that is undertaken, and you should be able to shop around for the best deal possible for you.
Well said. Stuart sent one in to us. Ben, hi Bryson. Ben, long-time listener, first-time caller from New Zealand. Love listening to all your podcasts every week. Quick question regarding my principal place of residence and mortgage offset. I have received a windfall, which I'm wondering the best use of. I could put it all into my offset accounts to get my mortgage, and with my current offset savings, this would be 100% offset against my mortgage, and I continue to pay it down over the next 10 years. Or am I better off paying down a large portion of it immediately, leaving the balance fully offset to pay over just a few years? I guess it's a matter of keeping the offset bucket full against the mortgage or paying down the mortgage ASAP. I also have one investment property which I need to reorganise to start offsetting ASAP. I hope this makes sense. Thanks. Stuart, it does make sense.
Stuart, so there's a couple of things going on there. If there was aspirations to buy an additional property, there may be an argument to recycle that money into the principal place of residence mortgage and pay down the non-deductible debt, and then release that money as a potential loan for investment purposes. And if it is for investment purpose, technically speaking, it is tax deductible. Again, speak to your licensed tax agent over there. If you're not doing any of that and you just want to know where to park it, liquidity is king. If you think about this logically, every dollar that's in your offset, Bryce said it before, daily is offsetting the interest cost. So whether you put it into the loan or keep it in the offset bucket, it is doing exactly the same job. Okay, so my view would be to top up that bucket till it's level, and then start putting money into the, as you were saying before, your investment property bucket. But there could be an argument here for you, if you do some analysis, if you're not close to retirement and you want to keep building your wealth, it may be time. It may be time, Bryce, to actually look at an additional investment property. We always say, 2, 3, 4 is all you need, and it's not being aggressive, and it's going to give you a passive income for life. So if you're in that position, maybe it's time to sit down and look at your cash flows and see whether, okay, I can use that money, I can recycle that out, because if you're starting to fill up the investment property bucket, then technically you're starting to receive more high passive income. Because the lower the loan to value ratio, it means you're actually going to be earning more. So it could be a time to add to your portfolio, Stuart.
Stuart, nothing further to add from me. You just heard from the genius. So thanks for your question. Hopefully that helps. Let us know. We will send you a book if you tell us where to send it over the ditch there. So very, very good. There you have it, folks. Q&A day, all about finance. Hopefully that helped. And hopefully there's some real ahas going on for you as to the opportunities that may exist for you if you can avoid #throttling Ben. Did I get that right? Throttling.
Yeah, mortgage throttling.
Hashtag mortgage throttling. There we go.
The regulators are into the throttling game.
Heard it here first, folks. You heard it here first. My life hack today is, well, I got the shout out, I think it was a week or two ago, where I don't throw any Android life hacks out there, Ben. I always do iPhone. So I did my research. I went over to Stiggy and said, what's your most...
research. Hey, Stiggy, help me out. Help me out. Can you give me
That is true. So I said to the Stig, what is your go-to life hack when you're using your Android? And she said, without a doubt, Ben, it's the slide to type. The slide to type. It's the millennials' way to type. Ben,
I have
no
idea.
Don't push I, lift your finger, then push V, lift your finger, then push I, then S, then E. You just go I, you just go I straight down to V. Don't lift your finger, Ben. Just go straight up to I, because the Android recognises that it's called lazy typing, Ben.
That's
but
amazing.
It works. And Iva said that is her go-to on her Android. So there you go, folks. Don't say I don't keep it balanced, Ben. That's fair representation.
Let's do the count. 940 Apple life hacks and 1 Android. Good round of applause, Bryce.
I said I've got
to see you on I've
got to implement these myself in most cases, so I wasn't able to on the
How's
Android.
Your push-ups going?
My push-ups are going
daily. Every push-up.
Thank you for. I may or may not be doing them daily at the moment. It is winter, Ben. So thank you for that. I appreciate that little heckle. But mate, you better be on point is what I can say. I hope you've prepped. I hope you're not going to do any shortcuts or anything with your Did You Know? What have you come up with?
Well, I've come up with going to our audience, Bryce, going to our community.
So you haven't prepped.
For my life hack. Well, no, we said if we've got great life hacks out there. Now, we've got this from Anonymous. He actually didn't give us his name.
Yes, but it's very good.
It's terrific. Did you know? So we're going to cut to it right now.
G'day, Bryce, Ben and Ivis. I'm only up to episode 166, so not sure if you're still doing the Did You Knows. This is not property related, but I've got a few stats that are interesting and more people need to know about. So, did you know? Around 1,400 Aussies are currently waitlisted for an organ transplant. In 2018, just under 1,800 lives were transformed by 554 deceased and 238 living organ donors. Only 1 in 3 Aussies are registered donors, despite the majority, 69%, believing that registering is important. And there's heaps more on Donate Life website. Thanks, guys, for your awesome info, including the extras. Loving the Mindset Minute, Did You Know, and the life hacks. Can't get through all of the info quick enough. Cheers.
Wow. Very, very altruistic, big picture. I think that's a very
important
good
stuff. So, whoever you are, Mr. Anonymous, reach out to us. We'll let us know. We want to acknowledge the people who give us all this great information. And, it is amazing in terms of people who do donate, their organs to prolong the lives of others. And I think it's a must do. So if you're not already registered as an organ donor, check out the site, do your best and, give so others can live.
Yep. Well said, Ben. So, folks, hopefully that's been an action-packed episode for you on a finance perspective. And stay tuned for next week, Ben. Got a very special guest. Going to take us into the world of very expensive real estate.
I was about to say the insider's guide
here we go.
To the best real estate in
Australia. You are, in fact, as a segue from what you just said, Ben, if you stick around next week, you are going to hear the story about Australia's most expensive house ever.
Sold.
I've prepped our guest. He's primed, ready to talk about that. So stick around next week, folks. Lots and lots to come on as we lead up to our 250th episode. We've got some epic guests planned for you. So stick around. If you tell your friends about us, we'd certainly love that, Ben. But until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Well said there, folks. See you next week. Hey there, folks. Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more and you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.